Hi, everybody, and welcome to our Q&A session with Brian Romanchuk. We're very, very happy to have you, and thank you for giving up your time to speak to our amazing students. I am going to hand you over to Jeff, who has done some interviewing with you already and will give us a bit of an intro. Thanks, Jeff.
Thank you, Gabby and Stephen and Brian. So yes, hello, I'm Jeff. I'm a Torrance student. I've taken 401 and 402. I'm planning on taking John Harvey Contending Perspectives in September and then Scott Fallweiler in February. Brian and I spoke recently for the second time about the secondary market. It's an interview. It's going to be released part one at the end of this month, part two at the end of next month. And so we wanted to invite we asked him to come on. Thank you, Brian, for coming on. And we wanted especially 402 students who specifically got into introduction to MMT to have the opportunity to ask some questions, and larger for everybody to just join in and to ask questions about bond trading, about primary market, secondary market, and related things. We have a bunch of questions already ready. So Brian is a bond analyst from Canada. And that's my introduction. Brian, why don't you introduce yourself a little bit better, and then we can get started.
Okay. Yeah. In terms of background, academically, I studied control systems engineering. I was a postdoc, but I finished off and moved into finance for various reasons. The publisher parish environment was kind of blah. To a certain extent, I was in an area that was mined out, and I had to find a new area to work on. And I said, hey, go into finance. And so I started two jobs. One sort of pure analyst. The second one was working for a fixed income manager, the Caisse de dépôt et placement de Quebec, which manages mainly public pension funds assets. So it's not technically a pension fund, but pension funds in Quebec leave their assets with them. And I worked initially was on the provincial bond team, but later on I headed a quantitative analysis team. And and so basically my sort of area of interest was government bonds, or what you call quasi-government bonds, things with very low probably default like provinces, and interest rate derivatives, not so much credit, but also sort of macroeconomic analysis. And in 2013, I resigned that position, and I'm now basically working part-time as a consultant and a writer. Bondeconomics.com. I have a Substack. I have a number of books. The latest one is an MMT, a book on MMT. But I'm supposed to be doing two books on inflation and banking, which I'm supposed to be working on. But in terms of how I got involved in MMT, we dealt with Warren Mosler's firm, and discussing with them and overlapped sort of my pre-existing views. And so it matched up, and it answered a lot of the questions. I didn't have a formal economics training, but the economist that made the most sense was Hyman Minsky. So I was sort of in a heterodox mode already, and the MMT sort of fit in, and it matched a lot of what you saw in for government bonds. So that sort of ended up, and I've been sort of writing MMT adjacent articles, not necessarily pure MMT, but things dealing with macroeconomics that touches on what would be of interest to fixed income, inflation, central banks, fiscal policy, but with a developed market focus. I'm not the person to ask about emerging markets. Anyway, so that's the end of my spiel of who I am and what my background is. And I guess now it's questions.
Yes, thank you. So we'll launch right into the Q&A. Jeff, do you want to sort of help me field the questions here? You had an idea for how we might start that?
Well, I think it makes sense for people to think about what questions they want to ask and maybe propose them in the chat. But why don't I would suggest that Brian perhaps start with the email ones that he felt that might be a good start, and then we can start accumulating other questions in the chat.
Ooh,
Brian, do you
with
want it?
this-
I can send it to you if you wish.
yeah, I'll have to
I have it.
find it.
I'll put it right in the chat.
Oh, okay. Well, I have it. I have it right now.
Okay.
So,
Well, I'll still put it
there's
back.
3 questions. Maybe you should put them in the chat anyway, so other people can see them.
Yep. I'll do it in just a moment.
Yeah. Okay. So the first question, in the U.S. and other countries, who conducts Treasury security auctions? And so in terms, I can't be. This was something I never worried about because we would be dealing with banks, and so the banks would be the ones bidding at auction. But in the U.S. and in Canada, I believe the U.K., not sure about the Euro area. The way it works is uh, the Bank of Canada is very specific. They conduct the auctions as an agent on behalf of the Ministry of Finance, like Treasury in the U.S. terminology. So the the you know the finance minister banks with the central bank, and the central bank handles all their sort of interface with the banking system, including auctions. U.S. I think similar. The like certainly for the auctions, it works the same way. I believe it's the same for the United Kingdom. For the euro area, it would be the national central banks, not like the ECB is sort of a federation of national central banks. If in the euro area, it would be the national central bank and not the central ECB. And so that's it. So they do it. They do it on their behalf, and so because the government doesn't have facilities for dealing with it, because the central bank, they do all their operations with the primary dealers, and I like that's an old terminology. It's US call, I mean, most countries call it that I'm aware of, but it might not be universal. But the way it works is the primary dealers, it's normal now they're banks, or technically a security subsidiary of a bank. It actually used to not be banks. Like in Canada, you had a strong division between the pillars of the financial system, and the banks wouldn't have been primary dealers. They'd be securities offices. Maybe they were, but they've all been, they've let the banks take everything over. And so the way it works is the primary dealers have to bid. They have the obligation to make reasonable bids to buy up an auction, and it's part of it's a requirement. Like the auctions are not supposed to fail. The banks are supposed to come up with reasonable bids, clear it, and it's an obligation. It's not, oh, we feel like doing it. They have to do it because the bidding in the auction is it's for the government. It's there, but then they then make money off that. How you make money as a primary dealer is you bid, and then at a certain price or yield. And then what you hope to do is to sell it pass it on to your clients at a slightly higher price. And maybe a little bit of speculative trading, but by and large, you are passing it on. You line up, you talk to all your clients, your sales team, you figure out how much they're going to buy, you bid, and then you pass it along to them, and you take a small haircut off that. So that's how they make money, but they have to warehouse because they're temporarily warehousing the risk of owning those bonds. So like they're not like they have to make money. Like a primary dealer is not going to do this without the possibility of making money. So why are we doing this? We're taking a risk. There's no reward. Forget it. So the system wouldn't work. The system is they have to absorb the risk because there is a chance they won't be able to unload it at clients at a profit. They can take a loss. They have to be able to absorb the inventory and then they sell it. And generally speaking, it's not all immediately flipped. They will keep it in inventory for a certain amount of time because the latest bonds are the most liquid ones. And so they have it in inventory, and then slowly they run down their inventory and until the next auction, and then they restock their inventory. So that's how it works. But in terms of the running, it's done because the central bank, when they're doing their open market operations, they deal with primary dealers. So they're already dealing with primary dealers all the time because they're buying and selling, because the central bank has to do operations to manage the money supply. And so they do that by buying and selling bonds or doing repurchase agreements. And they do that they deal with the primary dealers. They don't deal with everybody, they deal with the primary dealers. So that is the sort of the standard way. And since there's no point in duplicating at the Treasury, there's no point in duplicating the central banks dealing with the primary dealers. So it stays. That's why it stays with the central bank. I'm not sure. That hopefully answered that question.
There is a lot of questions in that list of
Yeah,
questions.
and then the next one, the harder ones. Okay, and then some people spend a lot of time hyping up possibility of a failed bond issue, and this is where it's very specific. Generally speaking, like you have to draw, what is, which is the country you're dealing with. Are they a floating currency sovereign? Like that's your most important question. And I mainly dealt with those, with the exception of the euro area, which is sort of a weird, it's a mess. But if you're dealing with the Germans, you can sort of pretend they're like the U.S. But if you're a if you're a floating currency sovereign and you're borrowing in your own currency, which they all basically do. They have small, other than the U.S. and possibly in the euro area, you will see other countries issuing small amounts of foreign currency bonds, and that's like Canada. Like Canada has some, so they do exist, but generally speaking, they're tiny amounts, and it can be thought of as a way of these countries. They have currency reserves. So the U.S. doesn't have foreign currency reserves; they have gold. Other countries have currency reserves, mainly U.S. dollars. They're generally negligible, other than Japan, of course. Other outside Japan and developed countries, they're fairly negligible, and to a certain extent, the foreign currency bonds can be thought of as a way of financing those reserves. But otherwise, the foreign borrowing is non-issue, and so then for the foreign currency, it's a question of, can the auction fail? And I mean, it theoretically can happen, and every so often you do. I think in Germany, every so often they will have an auction fail, but it doesn't really matter that much, because one thing to keep in mind is that the way the systems work is the Treasury banks with the central bank, and they have a bank balance, as it were. I mean, the central bank is a bank. It's a bank for the government as well as private sector banks. And governments will not run down their balances to zero. They'll have, they will have a large balance in there. Since they own the central bank, it's money that they owe themselves. It's not really that important, but they keep it at a positive balance anyways. And so even if you fail the auction, so what? they're not going to run out of money immediately. They would have to fail a series of auctions. So I believe the Germans every so often will have an auction blow up, but it's not that big a deal. In the United States, what would happen? One suggestion that I heard off the record was that they would just pull the computer and say, so we had a computer failure and we're going to do this again. And the thing is, you have to remember, they can do this and they're going to phone all those primary dealers and say, hey, wait a second here. You're obligated to bid. It's not, you can get out of being a primary dealer. Like, banks will decline and stop being a primary dealer, but they're obligated to bid. So they just would wrap knuckles really hard and, say, hey, we're going to try this again. And so generally that's the thing. So it doesn't really, you get bad auctions, but they don't fail. But in terms of, could you have a crisis? And this is where I guess you could look at, like, this, outside of Canada, you don't hear about it much. But in 1994, there was the Canadian fiscal crisis. And it's a big deal in Canada, but nobody outside Canada cares. And frankly, a lot of Canadians like myself didn't really care. But that was the thing. And there was a scare about, oh no, we're all going to die because auctions are going to fail. And there were no failures, but somehow the government was convinced that there were going to be failures. And so there was a fear of failures. And admittedly, Canada had very poor inflation. They had very poor inflation control. And so basically, everyone wanted to tighten fiscal policy so that they could kill inflation. Admittedly, at the time, inflation was relatively low because there was a small banking system blow up in the U.S. and in Canada in the early 90s. There was a condominium bubble that burst, but that was fairly localized in Canada. It was Toronto, Vancouver. So that blew a hole in the economy. It was a rough recession. That's one reason I went. I went into a lot of people went into academia from engineering to get away from that recession. It hit electrical engineering very hard, which I was, because the end of the Cold War was pretty rough on electrical engineers because it was a big part of the defense. So it was a pretty ugly recession in the early 90s for some sectors. And so inflation wasn't bad, but the fear was it was going to come back. But there's a lot of bogosity about this crisis. But that's one thing where you could say, look, oh no. But the thing was, it was nothing actually happened per se. You can't say, oh, there was a default or an auction failed. It was all, oh, it could fail, and then the government changed course. They tightened fiscal policy. So realistically, that's what you could see. There would be a manufactured crisis that you have to do something. But it's very vague. It's not, because an actual failure, what would happen? It would destroy the banking system. It would blow up the banking system and all the financial markets. So it would be bad. And the thing is everyone sort of knows that. Like, if you look at what you'll see is if you talk to like bank economists, say, oh no, we have to cut, we gotta cut spending, blah blah, inflation. We say, oh well, we need we have a fiscal crisis and we got to do something about it. But if they would scream bloody murder if, oh, by the way, your employer is going to go bust because your bond portfolio is going to get wiped out, they're not going to be happy. So it's a fairly hypothetical risk. There's way too many important power centers that would be outraged with the default that you would need something big. You need something like a hyperinflation, losing a war, that they're actually going to do it. They're like a default. The people talk about it as a way of forcing austerity, but it's not. It's not going to happen. except of course, Euro area where the ECB did basically, crush the periphery. Would the ECB do that to Germany? Well, probably not. And that's the sort of thing. That's it's but that's sort of a sort of becomes a political analysis. Is the central bank willing to do it? Yeah, they were willing to do it to Greece. Could they do it to Germany or France? Yeah. So that's sort of thing. But in terms of legality, there is an issue. Is it even possible to default? And the thing is, I'm not a lawyer. At my old job, if there was a legal issue, what you did was you called in your very expensive in-house lawyers and you'd get an opinion. And they're busy, so you didn't spend a whole lot of time chatting with them about hypothetical possibilities. But yeah, you would, I don't know. But in some countries, UK for sure, US, everyone, the debt ceiling comes up. Everyone knows about the debt ceiling in the US. It's a question of, is it possible? Is it legally possible for there to be a default? And it's untested, but in a lot of cases, the answer is probably not. And the question is, could the central bank force it? That was in one of the questions. The central banks, it's sort of the opposite, sort of the mainstream. They've gone the opposite of not wanting, to go into law. They just basically made up their own definition of what central bank independence is without any discussion of what the law says. So if you talk to an economist, they'll say, "Oh yeah, the central bank could just push." Mainstream economists, they'll say, "Oh yeah, if they want central banks independent, they could force the government to default." But if the actual sort of non-pure economist people working at the central bank, they've got legal teams, they know exactly, those people know the legal framework there, and they're government employees, and they have to follow very strict rules. I mean, they have the ability to print money, so they don't, they're not going to say, "Oh, you can do whatever you want." Giving someone the ability to print money and do whatever you want is not exactly good governance. So they are tightly constrained in what they can do. I mean, they're free to set interest rates. That's really what it is. But can they force a default? Not so much. But that's the thing. That's going to be a legal issue, and it's going to be jurisdiction independent. But by and large, it doesn't really make sense. Like, it's not something to worry about, because it never make it. Basically, it's, if there's a fear of a default, it's a free lunch. I mean, people say, "Oh no, people don't want to buy the bonds. The bonds get cheap." Well, it's a free lunch for people say, "No, they're not going to default." And Warren Mosler did that in Italy. If I believe Seven Deadly Frauds, I believe his book, he discussed how we made money off Italy doing that trade. Like, basically, in order for like the government bond to collapse, you got to get pretty much everyone on board and push it that way. And the problem is that you make money by defecting from that consensus. You can make a lot of money, and there's not a lot of easy ways to make money in government bonds. So it's not something that's easily arranged. So
Thank you.
I don't know if there's any more, but that's, I think, the end of that.
I think that's answered a few questions in one there. And there's been a lot of questions coming through. If you see me sort of looking to the side, I'm getting messages left, right, and center. A lot of questions coming through. But shall we go? I'm just going to go back up the chat, sort of from what I can see. There's a question from Susan, which I think essentially boils down to why issue bonds at all. And I think Stephen asked the same question earlier on. Do you have a kind of
my initials, as someone who writes about government bonds, it's my interest that they do. I'd have to write about other bonds or something like that. But why it's okay. It's very simple. It's interest rate policy. And do you want an interest rate policy? Like obviously within MMT, there is the idea of locking rates zero. But even there, uh, what you would probably see in practice is that the government would still issue treasury bills under a different framework. I think I think I saw this from Warren Mosler once. I haven't seen in a lot of places, but a lot of things would break if you don't have treasury bills. Things throughout the financial system will break. But the way you would do it differently is you would just say, oh, instead of leaving money in a bank, you would say, I'm buying a treasury bill from the government at a fixed rate. And it's like a savings product, but it would be traded almost the same. Like you just basically, the government would just issue, you'd have an auction of these things at 0.25% probably. Like, if you want zero, in practice, it'd be a 0.25%, and you can just buy as many treasury bills as you want. And so they would, even there, it would exist. It's a 0.25%, so it's not a big deal. But the current system, the way it's supposed to work is that you need it. If you had government bond, like if you say, like, let's say you have these treasury bills at 0.25%, or let's just say zero. Well, the problem is that means the risk-free interest rate is zero. And it's going to drag down. Private sector interest rates they're going to be dragged towards that 0%. There's going to be a little bit of a small percent. Like in Canada, the typical mortgage is like a 5-year mortgage. If you had permanent ZIRP, zero interest rate policy, ZIRP, if you locked rates and you guarantee that rates are locked at zero forever, I would guess that a Canadian mortgage in the secondary market be about 1%, maybe a bit less, 0.5%, but you would pay a bit more as a borrower. There's a cushion, but basically you'd pay at a higher yield, maybe 2-3%. I'm not sure what the margin is. And then all the fees, the stuff that gets sliced off that, and then you'd be left with mortgage bonds that investors would buy. But see, that's the thing. You would be the private sector, the base interest rate would be locked at zero. So you would have no more ability to use interest rates to influence the economy. And the argument, in the MNT circle, well, it's not very effective. You don't want to use interest rates. But the problem with that, which I ran into, I was in the Canadian Economists Association. I was at a CEA conference, and the answer is you've got two main policy levers. Well, they say it's like you have fiscal and monetary. This was mainstream, so they ignored like regulatory policy, but you have these two policy levers for macro policy. And okay, fiscal's there, but if you lose monetary policy, you have one less lever. And that's the thing. It's a tough sell. Why are you taking away interest rate policy? But that's it. So, you have to convince people that you don't want to use interest rate policy. But the reality, the fact is that the widespread belief that monetary policy is the best way to do macro policy. So it's a very uphill battle to win that fight. So, but so
it's a political question.
It's a political and technical, because you got to convince it's across the spectrum. It's not, you'd say the consensus among non-MMTers that interest rate policy is the most effective way to manage the economy. So, and that's across the entire political spectrum. Like all three political parties would probably agree with that, give or take, and Canada. So the three main political parties, with all due respect to the fourth and fifth. Well, actually, no, I guess it's true. There's a Quebec party. Yeah. But anyways, But that's it. It's a fight. It would be a big political fight to lose interest rate policy.
Mhm.
The you know the way interest rate policy works, the central bank sets the overnight rate, but all the bond yields are going up and down with with that overnight rate, following the expected path. And so that's how the system
Can,
works. And sort of it's as long as you have interest rate policy, you have to issue bonds. That's that like you're giving up on interest rate policy if they don't issue bonds. And so
can I can I bring
that's
in
the answer of
Marcus's
why.
can I bring in Marcus's question then, because I think that sort of follows on, which is that
Okay.
given the process, mechanisms, and frameworks to manage this and enable public spending is overly complex, opaque, and unnecessary, some of it. If you were provided with the opportunity to change things and rebuild the system, what components would you keep and what would you get rid of?
Well, I mean, the in terms of opacity, I mean, the credit system is opaque in general. The way the private credit markets are opaque, and they're opaque for a very good reason. From the perspective of the investors and also the borrowers, the all of the big flows in the private sector for financing private sector activity, and also goes to the government. All these big flows are going through very large funds, and they take large positions. Like to give you an idea, like I was at a $40 billion fund, which is like big by Canadian standards. We wouldn't look at something unless it was at least $100 million position. Anything larger than that was a waste of our analytical time. We can't look at small trades. And so you have very big trade, and you're warehousing large amounts of risk. And then what happens is all the people that you're dealing with know that you have a lot of risk, and they squeeze you on pricing. A lot of the pricing moves, they move it around, and they want to see if they can force you out of your position. And so that's why everyone likes a certain amount of pass, because you want to hide your positions from all the sharks out there. And so that's why everything is caught in veil, because no one wants to let anyone know what they're doing. Um, equity markets are very different. They're sort of aimed for retail investors. They have a much more rapacity is good. Transparency is good. But equity markets don't raise any capital. Like they're basically, equity markets are just shuffling around existing claims on firms, and every so often they raise relatively trivial amounts of money in initial public offerings. Look, if you look at the size of an IPO, well, okay, maybe $1 billion is a big IPO. A U.S. Treasury auctions, when I was there, was like 10 billion. I think they're now 12, 15 billion. That's a single auction, and they're doing that all the time. Like it's the new money flows in fixed income are huge, and that's it. So to a certain extent, yeah, it's just anything involving credit is opaque because that's just the way it is. You can say,
Mhm.
well, should the government, if they want to interface, like if they want to be part of the overall credit markets, they sort of have to fit into that department. Like, you say, well, the government shouldn't be opaque. Well, they don't have to be. Like the Treasury, a central government, especially like the U.S. Treasury, can afford to be transparent, and they are transparent. But like it's all the stuff they do, by the standards, it is all transparent. They say this is our auction size. It's all fixed. They're not doing backroom. Everything is supposed to be above board and follows rules. So but the thing is, it's probably confusing, but it's actually pretty, from the perspective of someone who's in the credit markets, it's easy to understand. And be honest, the credit markets, I mean, the trades, minimum trade size like 2 million. So, there's not many retail people involved in it anyway. So it's not like they're going out of their way to educate people on these things, because it's very much a wholesale market aimed at institutional investors. So, so in terms of how, like, what I would change, the only, like, if you keep interest rate policy, the only sort of big technical change is let the central bank issue the bonds. The Treasury, the fiscal, Minister of Finance, they just borrow from the central bank, and then the central bank just issues bonds to run interest rate policy. And that would eliminate all the issues that are going to default. Then you have to say, who's going to default? The central bank, Lowell, I believe, like it's not going to happen. The central bank is not going to run out of money as long as it's dealing with their own currency. And then that's it. And then you can say, well, should the central bank be borrowing? Well, then you can say, well, should that would turn into, should they lock rates at zero? But then you could say, well, we'll just end that and just lock it at zero. Otherwise, if you want interest rate policy, it's purely under the control of the central bank, and it shouldn't be a political issue.
Stephen, do you want to weigh in here or not? No.
No, I wouldn't wonder up Brian's narrative. I've just been, I just suggest that the central bank could equally well offer wholesale term deposits, which are functionally equivalent, but would mean no more bond dealers anymore, as far as government bonds are concerned.
Well, it's functionally equivalent, but to see a term deposit is not going to be useful for liquidity management. Like, it has to be negotiable. And as soon as it's negotiable, it's a bond. So you're not, and it's needed because banks need government bonds for liquidity management. And otherwise, what do they use? I mean, okay, they're stuck with reserves, but then if the reserves don't pay interest, then okay, you're observed. Or if they pay interest, but the thing is that it's wiping out on the rest of the private sector's liquidity management. And you could say, well, tough luck, but the problem is that if you say, oh, we don't want pension funds lending money to the government, then that you're still going to have something like the government the debt GDP. You can say the liability to GDP ratio, it's got to be held somewhere. Who are going to hold those liabilities? And if it's not going to be something like a pension fund, like who? Why do you want to own these things? And it then forces everyone into riskier securities because they don't have safe government bonds. And then in a financial crisis, the private sector can't manufacture. This is like a Minskian sort of thing that in a financial crisis, the safety of private sector liabilities disappears, and then that snowballs because if an entity, if you own what were once safe private securities, but they're no longer viewed as safe, you're no longer safe, so your securities, so it'll just steamroll through the system. And that's what happened in 2008. Everything starts to collapse because everything in the private sector is questioned. So, the only thing that in a financial crisis, the only asset that goes up in value is government bonds, and that's it. So having these government bonds provides stabilizes the financial system. So, that it's, you could try removing that, but then you're saying, okay, what are you going to do to the stability of the system? Because you could say, well, if it's non-negotiable, there's very few, like a mutual fund can't hold something that's non-negotiable because like a mutual fund, I'm not sure in Australia they call them unit trusts. someone wants to withdraw their money from the mutual fund, well, they're stuck, right? I mean, they have an asset that can't be redeemed, so they can't own them. Pension funds, in theory, could hold these deposits, but it's going to be very unattractive compared to anything else. So it's like, why would I'd rather own a bank bond that I could sell than lock in the government. And maybe you could do a small on your portfolio because you're not turning over your portfolio continuously. You can sort of guess these are safe, but if I'm going to have a locked in asset, I'd rather own a building and not a government. Why would I hold a government if I've got something illiquid? Why hold a government loan versus owning a building? And if I want liquidity, I'm going to buy a bank bond. So that is why it's built into the whole system.
Can I throw to Damien? Damien's got a question for you. Is it following on from what we were just talking about, or something else?
Yeah, it's following on. Thank you, Gabby. Hi, Brian. I'll ask my question both at the start and the end to provide a little clarity. It's also coming off from your recent analysis of Alex Douglas's How the Engineering of Arches Explains Money. I thought it was like a great little article, and you kind of comment on this too, but particularly about the philosophy of engineering and the method of rhetoric. And as MMT economists, we all tend to focus on how the system works, but without much consideration to the philosophy of economics. And it brings me to my question. Like, if we were to use, say, dialectics to answer what you say are political questions of why bonds issued, who would want to hold bonds necessarily, how does this change your analysis from just, say, an analysis, a synthesis point of view of how it works and operates?
Like the why question. I mean, I guess so the analysis, like the way the way you control this was control systems terminology. It was in engineering for people who haven't read. Is we had two sort of ways of describing what you're doing. Analysis was because control systems engineering is analysis of the mathematics of systems that you're trying to control. And the analysis is just what are the mathematical properties? You're given a system, like a thing, the plant that you're trying to control and your controller, given this feedback loop, how does it behave? And then the sort of the harder question is, you have a plant, come up with a controller that gets the plant to behave a certain way. And that was design or synthesis. And so in terms of like to try and respond, so like the analysis of the system is like how the current system works now. Like why do people own bonds now? And sort of when you say, well, why are we doing it this way? I mean, you can change it, but the question is, the reasons why people hold bonds now, comes from analysis would say, look, what are the potential options? And like I said, I'm not like a non-negotiable deposit doesn't work for a lot of the current holders. Like a treasury bill, like it might pay zero, is actually almost more useful than a non-negotiable deposit. Because if you're a large investor, you don't want to leave money in the bank because the bank could go bust. So given the choice, you have to own something like a treasury bill. Even if it pays zero, you don't care. But something that you can't sell immediately, it doesn't give you liquidity. So that's, the analysis says, why does the system work the way it is? And you can say, well, how can we change it? And I mean, you can. I mean, there's like you could make a lot of small tweaks, but like if you make a radical tweak, you then have to say there's going to be knock-on effects. I mean, if you want to, you can like get rid of the pension system or something like that. You can do that. But that's sort of one of the issues, like with the zero interest rate policy, you're going to blow up all your pension funds. So, someone who's on the verge of retirement I mean, it's not like looking at the demographics, it'd be much better to have done that in the 1960s when pension funds were essentially negligible and everyone was young. Now you got a huge overhang. So but you have to say, what are the effects? Like, and there's sort of while you got to extrapolate the analysis that you've done to, if you have a new system, what do you think is going to happen? But on the financial side, it's pretty, like, the way the financial system works, you sort of know how it's going to operate. Like you can say a change and they can tell you almost immediately, okay, this is how they're going to react, because the way things are done, like there's an economic logic, and as long as you keep the sort of the financial capitalist system roughly where it is now, you can guess almost immediately, oh, if you make this change, how will they react? What it means for the economy, what it means, like, does it make the world better? Okay, that's a harder question. Like, what's the effect on the real economy is going to be a harder question, but you could tell almost immediately what would be the reaction of the financial market to any change, because what the constraints, what they're thinking about, what they're looking at.
Thank you. That's very comprehensive. I've actually learned a lot just like absorbing all of this. I don't really know much about this area at all, so I'm sorry if my my reading of the questions is a little bit unexpert, I might say. Jeff, you had a question that you put in the chat. Would you like to ask it?
Sure, thank you. Brian, can you just briefly review, you were telling me about when we spoke about the, and kind of related to Susan's question and the idea of not selling bonds, that we link real world things such as retirement and pensions to interest rates and bonds and other things, such that the MMT, setting aside just for a moment, you're about, we need bonds for liquidity, that's interesting, and I don't want to go there right now, but the idea of that if we did what MMT says of putting, doing ZIRP and that we could stop selling bonds, that has real world consequences. One example being retirees would be harmed. Can you kind of review some of the real world, like we choose these things to be linked, and therefore there are political ramifications to doing what MMT recommends?
Well, I mean, you could work around it, but it comes down to if you lock interest rates at 0% nominal and you have and you keep inflation at 2%, government bonds are going to be losing 2%, in real terms on average, and that's pretty unattractive for someone who's retired. So you're going to force people to move into riskier assets in their portfolios. And you could say, well, okay, I mean, you could adapt to that. Like there's no guarantee, like why should you guarantee a return? But that's the thing, is that the problem, the way the system is now, I'm more familiar with the Canadian and American system, but what we've done is we dismantled defined benefits. Say like a defined benefit pension fund, probably they've got managed, they can figure something out. But the problem is, starting from the 1980s, we pushed the sort of the private sector pensions into defined contribution. And so now you've got individuals managing their retirement portfolios, and they're not experts. So they're just sort of picking mutual funds based off, not particularly expert advice from people like, their local bank branch. So the thing is government bonds that offer a decent return was an easy, there was that safe option, and you get rid of that, okay, you've eliminated the safe option for those people. You say, well, that's, the problem, you say, well, they, tough luck, but that's the thing you've done, and it's a big voting block. and they're not going to be happy about it. So it's also a bit of a, you can argue it's a bit of a change of the rules. They went into retirement under one set of rules, and then you're changing it, so they're not going to be happy about it, like in a sense. But that's it. I mean, you could work around it, but it's maybe it's not really the end of the world. You'd sort of adapt, but it's probably it's going to whack. There's going to be a distributional question for people, basically middle class. Anyone middle class that didn't have a defined benefit pension, they would have had a certain expected return, and it's going to be lower realistically. So they're not going to be happy, but they are a big voting bloc. So it's but that's the sort of thing. That's where the ZERP would run into issues. But to a certain extent, we've ended up in that world anyways because of the new Keynesian central banks. They cut rates to zero. They did manage to get rates away from zero in the last few years. But you could if you look at the 2010s, the rates were stuck at the low. So to a certain extent, we weren't far away from there anyways. And Japan has been at ZERP since late 90s. So, I mean, society can adapt. I mean, there's a distributional cost, but it's not, it's survivable. But the issue is that it's sort of hitting people who aren't really going to be aware, they didn't have the expertise to sort of deal with it. People with investment expertise, will work around it.
Thank you. So we've got a short time left. Some people have to go to a class in about 5 or 6 minutes. So we might try and wrap up pretty soon. There's a lot of questions actually. There was one from Matt, which I'm just trying to scroll up and find, that I think we missed. I'll try and come back to that one. So Matt says, Brian, you've written a lot about break-even inflation rates in the past. If we believe that inflation is often derived from real-world events, COVID, supply disruptions, and war, the downstream events that are relatively unpredictable, Weber's seller's inflation or excluseflation, he's put in brackets. How would you describe the utility of break-even inflation rate analysis to an MMT informed audience?
Well, the value of it, I mean, it's a market guess, you could say. It's what's embedded in the market. I write about it because people fixed income, because you make money off that. It's an investment. Like, do you want to own conventional bonds, or do you want to own inflation-linked bonds? They contain some information. I mean, it's not perfect, but people have gone too far saying that break-even inflation is terrible, tells us nothing about the future. I mean, it's a best guess. Like, if you think it's wrong all the time, and you got the right answer where inflation is going to go, well, hey, there's a big market where you can make a lot of money. And the fact is that, generally speaking, people don't make a lot of money being right on inflation in over periods of time. So it's really a market expectation, and it's just what's priced in, and it's how useful it is. I mean, people can be wrong. That's the thing, but it's to do better than them is tough.
Thank you. There's probably some other questions through the chat. I'll just post the link for those who have to go off to the other class. I'll just put the Zoom link there so that they can jump straight across. So Lachlan's got a question here. We've talked a lot about major system changes, but yes, we might have covered this one, but I think Marcus asked about changes that you might recommend. Are there any small tweaks that you might recommend?
To the system? Well, I mean, generally speaking, like overall, like it's more of a question of the Treasury needs to take on more responsibility for inflation. You know, it's been pushed to the central bank, and it's politically convenient that way. But basically, you know, in terms of why is this, you know, where's the dysfunction coming from? Is that fiscal policy is supposedly about managing debt GDP ratio, and the central bank worries about inflation. You know, they need to be integrated because debt GDP ratio is meaningless. You know, they should be worrying about inflation, like in the policy, and that's how it should be phrased. So, but that's sort of, you know, a real world change. But after that, like the system, you know, it's fit within the private system. So the actual mechanics, they're done a certain way because, you know, it works. I mean, that's it. It's just economically useful for everybody involved.
All right, thank you. So let's just wrap it up pretty soon, but does anybody want to ask a question from the floor, so to speak? I've seen a couple of people have to leave, so let's just do one or two last questions and then finish. Any hands up? Stephen? No? Jeff?
Well, if you'd like me to ask a question, I'll ask a question that I typed earlier, which is an interesting one. The failure of Silicon Valley Bank.
Oh yeah, we didn't
earlier
get to
in the
that
year. That was a rather unusual bank failure, and it was certainly related to the bond market and to monetary policy. Maybe it would be nice to hear from Brian his take on that. It didn't turn into a general banking crisis, but it did lead to some very significant changes in policy in the US.
Basically, don't want to say anything against myself sued here, but the, you know, people running were idiots. So what happened was they, you know, they're venture capitalists who didn't really, you know, they're banks, but they didn't understand how to run a bank, a modern bank, where how to manage interest rate risk. And it's just insane. Like from, you know, like a Canadian banks, there's only a handful of big banks. I mean, they're small savings institutions, but like they say, what? How? No, it's just crazy. Like the risk management is professional, and it's like anything you heard about, it's just crazy. But basically, they didn't manage their risk, and you know they relied on, people said their deposits, but their deposits were very large blocks of money from a few institutions, and that's wholesale funding. And I mean, realistically, normally in banking, you have deposits, which are supposed to be sticky and, you know, not supposed to, you know, not go away quickly, except there's a run. But wholesale funding was always assumed to be, you know, I think it goes wrong, it moves quickly. That's what happened in 2008. That's what happened in Northern Rock, and it's unstable. But their deposits were wholesale funding, and the wholesale funding, you know, left. So it's not really shocking. It's shocking that they survived as long as they did. You know, basically because the people depositing money were venture capitalists who, you know, they weren't credit people. Like if like Northern Rock, they were relying on borrowing from people who know how to do credit risk analysis. They would have, you know, anyone who could do credit risk would have, you know, ran, you know, like 6 months ago. So it's not, I mean, and it's spread, but you know, there's other weak banks, because there was pressure from, you know, very rapid rate hikes had put bank balance sheets a bit under pressure, so they reacted. But in itself, it was, you know, some very badly run banks blew up, and that's what happens to bad banks. You know.
Great. Thank you so much. I think that might be a good place to wrap it up. Just wanted to, say thank you again for sharing your time with us. And we'll be keeping in touch, and we've got the links to your website. So perhaps would you mind if students perhaps had follow-up questions? Would you mind them contacting you?
Sure. Yeah. No problem. I mean, if I were smart, I might just put up a short. I'll put up a short article. Like I have a Substack and also the site. I could just put up a short stub, and people can leave comments there, and they can be seen publicly. I can answer them there. It's probably easier than messaging me. I'm also on Twitter, but and other Mastodon and thing, but mainly active on Twitter. But I can put it up there, and then you can just leave questions.
I think
people should follow Brian, and I get regular emails from Bond Economics, and there's a series of fascinating articles. Brian's writing them all the time, so everyone should follow Brian on Twitter and Bond Economics.
Absolutely. Jeff, you'd like to say something before we wrap up?
Yes, I just, for the people in the recording and for later comers, I just want to remind that at the end of this month, there is a 2-part interview that's going to be released. Part 1 at the end of this month, and then part 2 at the end of next month, which will cover a lot of ground related to a lot of the questions from tonight. So thank you.
And we should remind everybody that the next Q&A is with Stephanie. Gabby, you're on mute.
Sorry, that's right. We have a Q&A with Stephanie Kelton at the same time in 2 weeks. So it'll be the 1st of August for people in the US, 2nd of August for Aussies. Wednesday morning for us, Tuesday.
We must thank Brian again, and just Brian's given his time to us and his expertise. It's been fascinating listening to him. So thanks very much, Brian.
Okay. Thanks for the invitation.
Thank you,
Brian.
All right, I will stop the recording there.